The 2024-25 tax year ends on Saturday, the 5th of April 2025. And with this date fast approaching, it's a great time to consider whether you're making the most of your tax allowances, which will reset for the new 2025-26 tax year. So in this vlog, we'll look at some of the financial moves you may want to make before the end of the tax year to ensure you're being as tax efficient as possible and in turn put yourself in the best position to prepare and save for your financial future. Before that though, a few points to note. Firstly, Better With Money provide financial education, so this video doesn't constitute any sort of financial advice. Rather, our aim is to give you the tools and knowledge to make your own decisions when it comes to your money. We're also totally independent and not linked to any of the organisations or websites I refer to during this vlog. We receive no financial incentive to point you in their direction. We just genuinely believe they offer useful tools and information which you can take advantage of. So with that in mind, let's take a look at our tax year end checklist, starting with step 1, review your income. The end of the tax year is as good a time as any to take stock and sense check your income. If you've recently received a bonus or pay rise or are due to receive a bonus or pay rise, then you might find that this pushes your annual income into a higher tax bracket, or there may be an impact on your benefit entitlement or personal tax allowance. So it's worthwhile taking stock and making sure you're clear on exactly what your earnings have been for the tax year. And that brings us on nicely to step 2, personal allowance. If your income is at or near £100,000, you should be aware that your personal tax allowance will start to reduce by £1 for every £2 of income above £100,000. Your personal allowance is the amount of income you can earn before you start paying tax. And this, for most people, this tax year is £12,570. But for those earning just over £125,000, they will have no personal allowance left, meaning you'll have to pay tax on all of your income. And if you're not on top of this at the time, you can find that you're hit with a pretty hefty tax bill. So it's worthwhile getting ahead. And increased income can also have implications on your entitlement to certain benefits too. For example, if you claim child benefit and your income increases above £60,000, you become liable to the high income child benefit charge. By the time your income reaches £80,000, you lose your entitlement to the child benefit payment completely. This is calculated for each tax year, so it's worthwhile doing a sense check to make sure you remain within the thresholds. And there are other benefits you might want to check too, things like tax credits or universal credit. The next point is around pensions, which are one of the most tax efficient vehicles we have access to for long-term saving, and they are tied to the tax year. Why? Because we get an annual pension allowance each year, and for 2024-25, that annual allowance is the lower of £60,000 or your gross annual salary. And this means that you receive tax relief on contributions into your pension up to this annual allowance. Or in other words, you don't pay tax on the money you put into your pension. So it's worthwhile considering whether you've made the most of your allowance or whether you might be able to increase your contributions before the tax year ends. And if you've already used your own allowance, you might want to consider paying into someone else's pension to make use of theirs too. For example, you can pay up to £2,880 into a pension for a non-earning partner or child and receive 20% tax relief. And once you've thought about your pension, why not think about your broader investments too? This tax year, we have an annual exempt amount for capital gains tax purposes of £3,000, which means we can make £3,000 in gains outside of pensions and ISAs without having to pay capital gains tax. If you have assets that you're looking to sell, you might want to consider whether you could make use of this allowance to minimise the capital gains tax you need to pay. Similarly, remember we can receive £500 in dividends each tax year before we have to pay dividend tax. So sense check any dividends you've received to make sure you're using this allowance effectively. And whilst you're thinking about your investments, you may as well think about your savings too. If you're a basic rate taxpayer, you have a savings allowance of up to £1,000, meaning you can earn £1,000 in interest on cash savings without paying tax. For higher rate taxpayers, this allowance is £500, and additional rate taxpayers have no personal savings allowance at all. If your interest income on savings exceeds this allowance, then you will have to pay tax on your savings interest at your highest rate. And this is where ISAs can come in. You can place up to £20,000 per tax year into an ISA, which is an individual savings account that comes with tax benefits. These are that any income or gains are not subject to tax. And you can open a cash ISA or a stocks and shares ISA, and there is the lifetime ISA too. So if you're saving and investing but not making use of your ISA, then you might want to consider how you can make better use of an ISA to try and minimize your tax liability. Now let's look at another allowance, which is the annual exemption for gifts of £3,000. This means you can gift up to £3,000 each tax year without this being included in your estate for inheritance tax purposes. So you're essentially able to reduce the value of your estate by £3,000 each tax year by gifting that away. And there may be other legitimate ways of reducing your potential IHT liability too, like giving a tax-free gift up to £5,000 when a child gets married, or making regular payments to someone else out of your income. IHT can get a little complex, so this is an area you may wish to seek advice on, but you can read lots more on the gov.uk website. Moving on now to look at charitable donations and more specifically at gift aid, which allows charities to claim back the basic rate tax you've paid on donations to them, meaning they get an extra 25p for every £1 you donate. Higher rate taxpayers can also claim back tax on donations they've made. So they can claim back the difference between the tax they paid on the donation and what the charity got back. And you can do this via your self-assessment tax return or by contacting HMRC. Again, visit the gov.uk website to learn more. Let's now move on to the last step on the checklist, conducting a financial review and seeking professional advice if you need it. The steps we've already been through require you to undertake a detailed review of your overall financial situation to help you understand where you're up to with your finances and whether there are any changes you need to make. And this will include looking at your savings and investments, any debt you have, and it should include a thorough review of your budget too. That means thinking about your income and outgoings and understanding whether you have a surplus or shortfall, and then thinking about what steps to take next. But sometimes we will need help, especially considering how complex tax rules can get. So do consider speaking to a professional financial advisor if you're unsure, as they will be able to help tailor strategies to your specific situation and can consider any changes in income or financial goals. We've been through a lot there, so I wanted to finish off with a summary of all of those points. So first of all, review your income, especially if this has changed during the tax year. Consider whether there has been any impact to your personal allowance or any benefits you receive. Think about your pension and whether you've made the most of your annual allowance and the allowances of your loved ones. Take time to review any other investments and savings you have too. Have you maximised your ISA allowance for the tax year? And have you maximised opportunities to be tax efficient when it comes to capital gains tax and dividends? It's also worthwhile thinking ahead to the future and whether there are inheritance tax planning opportunities. And question whether there are any charitable donations you've made during the tax year which you could reclaim tax on. And finally, remember that tax can be complex. So whilst there are certainly actions you can take for yourself, you may wish to seek support from a regulated financial advisor to make sure you're being as tax efficient as possible given your personal circumstances. Thank you for watching.